subject of personal financial planning, we are having lecture series of investment decision making, and investment avenues was the topic of my last lecture. In this lecture, to start with, I'll be talking about principles of sound investing. Investment should match the investment objectives. This is one. Diversification, power of compounding, tax benefit, hedge against inflation, save regularly for investment. Investment should match with the risk appetite of an investor. The list is not exhaustive, but nevertheless, these are the certain principles which any investor, while making personal financial planning, must take into account while investing his hard-earned savings or her hard-earned savings. Let me take one by one. Investment should match the investment objective. Friends, howsoever the good investment may be, if when the time comes, when the purpose for which you are making the investment, at that time you are not able to use it, I think the very purpose of making investment will be defeated. Right? Say for example, after 3 years, 4 years, I have to get my son in a school, or I have to send my son for higher education, for which I will be requiring say 20 lakh rupees. And I have bought a flat which is growing also, with the value of investment is growing. But for having 20 lakh rupees, for meeting out the expenditure of 20 lakh rupees, should I sell my flat which values around 1.5 crore rupees in a city, right? And if I sell it, what I'll do of the other money that will be remaining money? So what I feel is that this investment of mine, which I have made over a period of time in the last 20 years, right, it is not matching with the objective. My objective is to send my son for higher education in a good university, in a good college. It is a private college, so I'll be requiring 20 lakh rupees, right? So for this, my investment in real estate, which is of high value, may not be of much use. Instead of, if I've invested this money in the last 5 years, 4 years, in a mutual fund schemes or in a gold ETF, right? And then when the objective arises, the purpose arises, then I'll dispose it off, sell it, and thereby the capital I'll make profit out of it, and using this 20 lakh rupees for sending my son for higher education. So what it means is that investment must match the investment objective. What your investment objective is. Again, let me take with the investment objective. Suppose I want that for the last 25 years, 30 years, I have been working and I have accumulated this much money. I want that rest of my life, I should use this money and I should have a regular income out of this money. Suppose I have accumulated 1 crore rupees in the last 20 years, right? And I want that this 1 crore rupees should give me the income, regular flow of income, monthly income, right? Where from which I can get my livelihood, I can get my personal expenditure met. So what I will have to do, right? I'll be investing in such schemes, in such avenues where I can get a recurring income. Either I will go for bank FD, which will give me in which quarterly the interest amount on the bank FD will be created in my account, or I'll buy some mutual fund units and invest in a scheme where there is a provision of systematical withdrawal plan. There is a scheme in the mutual fund where there is a systematical withdrawal plan, that is from the investments every month, every quarter, as the investor desires, right? The money is being created in the bank account of the investor, right? So whatever investment you are doing, it must match your requirement, it must match your objective, the purpose for which you are making the investment. So most of us, or many of us rather, I will say, do invest without thinking what is the purpose of investing. We only think that the purpose of investing is getting income out of it, right? When I say income, what do you mean by income? Income, whether it is matching with your risk, whether it is matching with your requirement. So you must invest so that your investment objective is matched with your investment. The other principle is diversification. Diversification means we always say never invest in one asset class, invest in different asset class. When I say asset class, in just my previous lecture, I talked about different investment avenues. I referred about equity, bond, bank deposits, means deposit related instruments. I talked about derivatives. I talked about real estate. I talked about gold. So there are various asset class. While making investment, we must diversify. Why should we diversify? We should diversify so that our risk can diversify. Supposing there are certain examples like in Japanese market in Japan. For the last 20 years, the stock market has not performed well. People say equity is a good asset class which gives you a very high return. But if in a particular market, say, I have given you the example of Japan, for almost 20 years, the Japanese equity market has not given very good returns. So, if any investor who has invested all his investment in equity of Japan, that is a Japanese, then it will be difficult for him because the investment is not growing. The value of that investment is not growing. Had he invested some money in gold, some money in real estate, some money in bonds, fixed bank deposits, so in that case, his risk would have been diversified or will get diversified. And if one asset class is not performing and the other asset class is performing, so thereby the person can make income out of it, can get return out of it. Even within asset, like say for example, equity, instead of putting all your investment in one equity, one share, you must buy basket of shares. You must buy 4, 5, 10 different companies, so that if one company doesn't perform well, if the stock price of one company doesn't perform well, at least in other company the price appreciation can take place, right? So there must be diversification of the asset class. When I say asset class, means different type of assets which you have, where you can invest. We always say first, some amount must be invested in risk-free assets. Risk-free assets means like bank FD, post office deposits, right? So the money which you have for emergency fund means your since 6 months monthly expenditure must be in liquid form, where any time when you need it, suppose you can withdraw it. So that is called the emergency fund. So emergency fund should not be invested in risky asset like equity, because equity, the value of the equity keeps on fluctuating. But the bank FD, the value of the bank FD will not fluctuate. If suppose I'm having a job and thereby I'm meeting my monthly expenditure, I lost my job. What will happen unless I have an emergency fund? So for that time, for that difficult time, I'll be needing the money, and for money I'll be resorting to my bank FDs or bank saving fund. From that I'll be able to meet out my minimal monthly expenditure. So the smart investor must diversify among different asset classes, and even within that asset, right? You must diversify. Say for example, even I can take the example of real estate also. You're a wealthy person, you want to purchase many real estate buildings or plots or houses. So don't buy all your investment, don't buy all houses in one locality. Supposing one locality, the surroundings of that locality because of one reason or the other reason doesn't develop, then the appreciation of that your investment will not get good appreciation, right? It will not give you good handsome returns. But if you have diversified, right? If you have invested in one part of the country, you have invested in other part of the country, or within city, if you invested in one part of the city, you have also invested in other part of the city, right? If one part of the city doesn't develop the way you was expecting, the other part may develop, and thereby the part that develops, the investment of in the real estate that develops in the developed area, right? That will increase manyfold. That will balance the investment which doesn't give you good returns. So diversification is a very important principle of sound investing. The other is power of compounding. Friends, if you ask me one simple rule of investing, I say you must realize, you must see the importance of power of compounding. It's a magical principle of investment. Every young person who is watching this program, who is seeing this program, must value this principle of compounding. That is, if you invest in a young age and longer is the time horizon of investment, higher will be the amount, the more with the wealth you will be able to create. If you invest for 5 years and if you invest for 10 years, if your investment in 5 years doubles, right? So in your investment in 10 years will be 4 times. So you can imagine, as the time period increases, the wealth increases at a very faster rate. So people who want to invest, they must understand this simple principle of investment, that is compounding. Compounding means longer is the period for if your investment, higher will be the return which you will be getting, right? In terms of accumulation of wealth, creating wealth. You may say for example, a person is making investment in bank FD. Bank FD will give you a fixed return, fixed rate of interest, or post office deposit will give you fixed rate of interest. How it helps in compounding? Because the interest which you get, interest on interest arises. So that is what compounding is. Suppose the bank FD is for 5 years. Every quarter or every 6 months, depending on the terms and condition, the interest that is being generated on then fixed deposit, say you have make a bank FD of 1 lakh rupees. So the quarterly interest, suppose the rate is 8%. So 8% is the interest on 1 lakh rupees, it comes to be 8,000 rupees. So every quarter the interest is 2,000 rupees. So on 1 lakh rupees, after a quarter, it will become 1 lakh 2,000. In the next quarter, the interest will be credited on not on 1 lakh but 1 lakh 2,000, right? So certainly it will be more than 1 lakh 4,000. So after 6 months, the interest will be calculated on an amount which is more than 1 lakh 4,000 rupees. This is what compounding is. And gradually what you find is, although the rate of interest is fixed, I am saying 8%, but since interest on interest is being paid, so that is what compounding is. And the longer is the period, the larger will be the amount that will be created by this investment. Suppose you make a bank FD for 20 years, 25 years, as you start earning, right, you become, the first job itself, right, you start making deposits in the banks. I'm saying banks, I'm presuming banks give you a low rate of return as compared to the other asset class, but since the bank investment is safe investment, so people tends to prefer that investment. But still, if you invest it for 20 years, 25 years, you will find a large amount of money you will able to accumulate even in the bank fixed deposit. Not to talk of equity class and the real estate and the gold, right? So this is basically power of compounding. Power of compounding principle simply says, the longer is the time horizon, longer is your investment time period, the larger is the amount of wealth you will able to create. The other principle of investing is we call it tax benefits. While making investments, this point I have talked earlier also many times, that we must see what is the tax implication of our investment. Means there are at 3 different points you can have a tax benefit. Like while making investment, there is a section in India called 80C section. Under 80C section, up to 1.5 lakh rupees, if you invest in certain investment avenues like public provident fund, like FDs for more than 5 years, there are many avenues, right? Like insurance, life insurance, even health insurance. So if you spend there, if you invest there, you get certain tax benefits. The tax benefits are in form of that the money which you have invested up to 1.5 lakh rupees, it is deducted from your total income for calculating taxable income. So you are able to save tax. Plus, there are certain investment avenues where the regular income which you will get, the interest income which you will get out of that investment, it is not subject to taxation. So another tax benefit. There can be an investment where while you getting your money back, means whatever the investment you have made plus the income that is generated by that investment, the sum total of it, principal plus the interest or whatever the return you have got it, right? So the money which you get at the time of the redemption or at the time of getting it back, it is not subject to tax. So at 3 different points you might have enjoyed, like PPF, 3 different points of time you enjoy the tax benefit, right? So we must see what is the tax implication. Many people buy equity because the capital gain which you get out of it, capital gain means the difference between selling price and the purchase price is called capital gain. So it is only, if you are a long-term capital gain, it is subject to 10% tax rate. Suppose I am in the 30% tax bracket, which is the highest tax bracket, plus surcharge, of course, and I make a bank FD, I make some other investments. So whatever the income, the profit that I generate by bank FD, the interest I generate after a particular sum of money, the interest which I generate by it, it is all subject to taxation at my incomes, at my tax slab, which is 30%. But if I invest in equity and I make capital gain, I sell my shares, thereby making capital gain. If I hold the shares for more than a year, it is called long-term capital gain. And on long-term capital gain in India, on individuals, the tax rate is 10%. So I do invest, or people may invest in equity and hold it for a period of 1 year, so that they know it, that it will not only give them, it is expected to give them capital appreciation, but also there will be tax benefit. The income that is being generated, the capital gain that will be generated by it, it is subject to a lower rate of tax as compared to my tax bracket, right? So it is not only for equity class. Equity, I have just given an example. I mean, recently the government of India has changed some tax laws in the debt funds, right? Debt mutual funds for debt schemes. So many people have shifted from these debt funds to other asset class funds, mutual funds, because the tax benefit of indexation. Indexation means as price level increases, the benefit of your, we presume, the cost of your investment also increases. That is called indexation. So the indexation benefit which many people were getting while investing, in the debt fund, Government of India in the recent finance bill, in the recent budget, right, they have changed it. So many people shifted from debt fund to other funds because the tax benefit which they were earlier enjoying, no longer they will able to enjoy that tax benefit. The simple point I am trying to make is that while making any investment, you must see what is the post-tax return out of that investment, because actual return is post-tax return, right? So what will be the tax consideration of my investment, the return which I will get on my investment, that is also a very important point. Other important principle is hedge against inflation. Hedge against inflation means that you should try to make those investment which can beat inflation rate of inflation in the country, because price increase and the value of money has inverse relationship. If inflation takes place, the value of money depreciates, decreases. And what we want is, at least minimally, the value of my money while making investment, whatever I am making investment, the value of my money should at least protect it. Suppose I am making a post office deposits, and post office, if at all, is giving me 5.5% interest. Or let me put it another example. If I am depositing the money in the bank savings and I have a good sum of money which I even don't require for my day-to-day requirement, I have kept it in the saving fund. No other consideration, only I have made my investments and I said let the money be in the bank. Bank is giving me 3% or 3.5% interest in my saving fund account. And the rate of inflation in India, suppose at present, current is 5.5% or 6%. It means after a year, my 100 rupees will become 103 rupees if the rate of interest is 3%. But what will be the value of this 103 rupees if the inflation rate is 5.5% or 6%? It will be certainly less than 100 rupees, right? So what it means is that 103 rupees which I am getting after investment, after this, the real purchasing power of this investment is not equivalent to 103. It is certainly less than 103 since the inflation rate is 6. So we, while making the investment, must see, or other say should see, keeping in mind other consideration constant, that the value of your investment or the return on your investment must beat the inflation rate in the country, right? So that you can make some real return out of it. One is called nominal return, other is called real return. Real return means nominal returns minus inflation rate. That is called a real return. So the good principle of the investment is that we should invest in those asset classes which can beat the inflation rate in the country, right? That is called hedge against inflation. Other is save regularly for investment. Friends, we are fortunate that we are in India. Indians by nature, people tends to save. In Europe, in many so-called developed countries, right? Whatever the income people generate, they tends to spend, right? But saving is a good virtue, I would say, that any emergency can arise, any problem can arise in life for which you have to mete out a very heavy expenditure. To safeguard yourself against those uncertainties of life, if you are a regular savers and thereby making regular investments, you will able to at least financially save, and you will able to create a good amount of wealth in life, providedly you have a habit of savings. So each individual must have habit of saving, and not only keep the savings idle, but also it must be invested in some productive assets. Productive assets means those assets which can give some amount of income. So we say save regularly for investments. And lastly, I would say investment should match with the risk appetite of an investor. While talking of the first point, I said investor should match the investment objective, right? It should not only match the investment objective, but also should match our risk appetite or risk. There are certain people, depending on the conditions, because each individual has different conditions. Conditions means its age, its income group, its other source of income, and so many other things are there. So even habit, your personal likings and dislikings. So depending on your risk appetite, how much risk appetite means how much risk you are ready to take. Your investment should match your risk appetite. Many people say, we don't want very high return. We are satisfied with a lower return, provided the risk is not there. Then bank is a good option, post office is a good option, bonds are the good options. Any deposit related investment is good option. There are investors who said they want high return even if there is an element of risk. They buy gold, they buy stocks, they make investment real estate, right? So each investor has different element of risk appetite, and depending on your risk appetite, you should take investment decision. So friends, these are some of the principles of sound investing. At the same time, I will also tell you don'ts of the good investing. These things we must keep in mind while making the investment. Avoid herd behavior, commonly referred as ostrich behavior. If everybody is investing in equity market, I should also invest in the equity market. That should not be there. Because those who are investing in the equity market, they may be having different risk profile than as compared to my risk profile. So do not have a herd behavior. Normally in common parlance we say, when people at the panwala shop and the chaiwala shop starts talking of the equity share, that is the time when we say the equity is peaking, the Sensex is peaking or Nifty is peaking, means it is a very high, the booming stage. And if you invest at that point of time, there is a likelihood that the value of your investment will decrease. Because at that point of time, there is a herd behavior that equity prices are going up, so we should invest in the equity market. If the real asset prices are going up, everybody starts investing in the real estate. If the gold prices are going up at a very hard rate, more and more people tend to start investing in the gold market. It should not be the investing principle. right? You should make your own judgment, right? That what is right, what is wrong for you, depending on your risk profile, depending on the principles which I've talked in a previous point. Avoid chasing tips. Especially in the equity market, people start giving, this is good share, this is you buy, invest this share, this, that share, right? Those tips, we call it, should be avoided. Do not expect quick returns. Sometimes people want to become wealthy at a very fast pace. But if you want to be wealthy at a very fast pace, you always keep in mind that the investments which you are making, they are very highly risk. Suppose you buy a junk bond. Junk bond means the bonds of such companies which are not highly rated, where the balance sheet is weak, the company is not making profit. That can promise a very high rate of return. But junk bonds are always risky, right? Avoid investing all money in one share or stock. I have already talked diversification. Do not buy stocks or bad companies, right? So these are don'ts of good investing. So thank you very much.